Hello Maverick Traders, this is Imre and welcome to today's class, Market Behavior and Fibonacci. All right, this is one of my favorite topics to cover when it comes to market behavior, and truly this concept is universally applicable to all financial markets. So it doesn't even matter if you're looking at a price chart of a cryptocurrency, a regular currency, a stock or a commodity, it doesn't matter. Because all financial markets are ultimately driven by human beings, the behavior across all financial markets is the same on a fractal basis. So enough of a preamble from me, let's get right into it. So first off, here's a quick introduction to Fibonacci. 13th century mathematician Leonardo Fibonacci da Pisa discovered a sequence of numbers related by a fixed ratio as the sequence continues to progress towards infinity. I know this is a little bit wordy, but it's important that we get through this, at least just so we understand on a base level what the Fibonacci sequence is, so that we can then understand what Fibonacci ratios are, which then allows us to start practically applying Fibonacci mathematics to market analysis. So anyway, back to the Fibonacci sequence. It's basically the sum of any two adjacent numbers forms the next highest number or the next higher number in the sequence itself. So for example, 1 plus 1 equals 2, and then you'd have 2 plus 1, which equals 3, and then 3 plus 2, which equals 5, and so on and so on. Now, as the sequence continues to progress, the ratio of a number in the sequence compared to the next higher number is 0.618 to 1. So the inverse of that ratio would be 1.618 to 1, and that applies to numbers lower in the sequence. So the ratio that separates numbers within the Fibonacci sequence is known as the golden ratio, and these are Fibonacci ratios, and they're incredibly important, not just in financial markets, but in all natural phenomena that we have observed to date, virtually. So that golden ratio 1.618 or 0.618 is known as phi as well. Now the proportions of phi are inherently pleasing to the eye and to the ear. Virtually, I would argue that if there was a way to quantify, smell or touch according to Fibonacci ratios, there might be something there. I'm not going to theorize too much, on higher levels of consciousness and so on, but it might be that one day we're able to distill the specifics of how phi is present to all our senses. But anyway, as far as the eye and the ear goes, we can find this ratio anywhere, from architecture to art, music, as well as in the natural world. So the golden ratio is seen in everything from the proportions of playing cards to the structure of sunflowers and even the spirals of galaxies in outer space. How cool is that? Now, here's something that's really cool, and we're going to touch on this in a little bit later. The golden ratio even appears within the structures of our very brains. So we're going to touch a little bit on that and what that might mean for how they appear, how these proportions appear in financial markets. So Fibonacci is the mathematical foundation upon which markets operate and behave. That's a big statement. All right, so what that means is that there is, let's unpack that statement. What is the Fibonacci sequence? Well, it is a pattern, all right? The pattern is very simple. You add the two numbers, you get the next number in the sequence, you add that number plus the preceding number, you get the next number in the sequence, and on we go. Patterns by definition are repeatable and predictable. And therefore, financial markets are also equally repeatable in terms of the patterns they create, which means they are predictable, okay? So the market is a fractal entity. And now, if you have questions on what that means, let me know. I don't want to dive too much into the mathematics of it all, but the important takeaway here is that because the Fibonacci sequence is the mathematical foundation upon which markets operate and behave, if we understand how this sequence works and how the ratios apply to market analysis, we can go a long way towards better forecasting and calling the market. So market behavior is simply a function of herding impulses, all right? It's really a function of everyone in the market deciding in real time what a specific asset class is worth, which is again really, really cool. And herd behavior is ultimately governed according to Fibonacci tendencies, which we will also be taking a look at in the next couple of slides. So a key example is how Fibonacci ratios govern wave formation, right? So the past few weeks, I've been talking about impulse waves and corrective waves and all the patterns therein. Now, all those patterns are, of course, related to one another according to Fibonacci mathematics. So progress in a market is determined by 5-wave movements. Corrective setbacks are in 3 waves. Guess what? 5 and 3 are both Fibonacci numbers. Humankind's collectively expressed emotions, manifesting in the price action that we see on a price chart, are fundamentally and inseparably tied to the mathematical principles of Fibonacci. That's why the best descriptor of the wave principle, or Elliott wave theory as it's otherwise known, is that it's not a trading strategy. It's not even a forecasting tool. At its core, the wave principle is simply a discovery that the same laws that govern the growth and decay of natural phenomenon is also present in human behavior, and we can apply this knowledge to our forecasting and analysis of financial markets. All right, now I am going to nerd out on you just a little bit. Now, this isn't necessary to understand how to apply Fibonacci, but I find this is going to appeal to those of you with a similar personality trait to mine, which is where you really want to, in order to fully buy into something, you really need to know the why behind it. Well, this is part of the why behind it. Okay, so Paul MacLean, an esteemed evolutionary theorist, came up with this concept of the triune brain. All right, so the theory basically states that the brain has 3 distinct operating systems, if you will. We have the primitive brainstem, the limbic system, and the neocortex. So we can broadly classify the neocortex as the rational part of our brain and the other 2 systems as pre-rational. So as part of the rational operating system, the neocortex takes information from the outside world and then processes it accordingly. So the convictions of the neocortex are malleable. So for a great example would be, the first time a kid sees fire, and has never interacted with fire before, that child doesn't know that fire can be dangerous. So guess what? They're probably going to burn themselves, right? They're probably going to put their hand in the fire or on the hot stove. They're going to get burned. And then logically, in the future, when they see a fire, they're going to be a lot more conscious and aware of the risks and dangers that fire or that hot stove might present. Now, the primitive brainstem controls instinctual behavior such as fight or flight, right? So you see danger, what do? Do you run from it, or do you run towards it to fight it? And then the limbic system creates emotional impulses that are extremely powerful and override rational thought, all right? So here is where we potentially get into heavier topics like addiction. And I'm not necessarily talking about the kinds of drug-related addictions that most people's brains jump to, but I mean something as simple as seeing, some people have these weird, I'd say idiosyncrasies where they have odd behavioral tics. I wouldn't even say they're odd. I mean, how many of you walking on a sidewalk, you see a crack in the pavement and you jump over it as a kid? I without almost even thinking about it, I'd argue that that's some kind of emotional impulse that's very powerful and hard to override. And then of course there are substance-related impulses too, behavior-related impulses as well. Someone cuts you off in traffic. What's your instinct? Some people will just start, just fly into a fit of road rage, and it overrides any rational thought. It's like, well, whether that person meant it or not, me swearing at them and getting all hot and bothered by it isn't going to help me in any way. But I can't seem to override that impulse to get angry, right? So just to give you some real world examples there. So this is where it gets really cool. The microtubules and neurons present in our brains are themselves structured according to the golden ratio, or phi. So it therefore follows that our pre-rational mentations, our pre-rational thoughts might themselves be perhaps patterned according to the golden ratio. And it turns out that it seems to be that they are. Now, there is a limited body of work on this, but what I have not found is substantive research that invalidates the findings made here that I'm going to cite. So Kelly, G.A. Kelly, made a fantastic study on choice in 1935. So human choices veer towards optimism versus pessimism, okay, in value neutral situations by an average value of, Guess what? 0.62. Remember, phi is 0.618, often rounded up to 0.62. Individual decision-making seems to veer towards phi-based tendencies. Aggregate behavior, in other words, herding behavior, shows even less variance from phi. So there was a psychologist named Vladimir Lefebvre of UC Irvine, and Lefebvre discovered that the median voting margins in California ballot initiatives over the last 100 years is 62%. In other words, phi. That same ratio exists in a study of all major democratic referenda in America over a decade time span. Now, these findings are perfectly compatible with stock markets. Consider the overall bullish trend of a stock market in relation to these findings that on an aggregate level, so on a herding level, human beings prefer optimism to pessimism by 62% margin. That's why human beings are fundamentally optimists. It is why over the entire span of time that we've had our human modern civilization, I'd say from the times when we started forming tribes and started building tools and so on, we have progressed. Yes, we have setbacks. Of course we have setbacks, and we always will. What we're living through right now is one of those setbacks. But there is one pattern to human growth and behavior, and that is that it's underpinned fundamentally by optimism, which I find to be really cool. If that gives me hope for our species, that as bad as things might be right now, they will over time get better. All right, so how does this all relate practically, to financial markets? Well, there are many ways we can apply Fibonacci mathematics. I'll be covering one method here today, the most common method that most people know of, and this method is called Fibonacci retracements. So corrective waves always retrace a percentage of the impulsive wave that immediately precedes them, right? We've covered this in my past classes. So for example, wave 2 retraces a percentage, no more than 100% of wave 1. Wave B retraces, for example, a percentage of wave A in a zigzag. And these net retracements typically end up approximating a Fibonacci percentage. Now, sometimes the retracement is like an exact Fibonacci percentage level, but most of the time that's not the case, which is why we shouldn't think of these levels as hard lines in the sand, but rather as high probability areas where the market may turn. So depending on where we are within the larger market cycle, we have guidelines that rank the probability of certain retracement levels being met over others, which is very, very cool. So if a stock runs impulsively from $0, let's say, it's trading at $0 and then runs to $100 and then it pulls back to $38.2, we can say that the entire correction retraced 61.8% of the prior impulsive wave. So here are some of the retracement levels that I like to look at. So this would be looking at retracements in a bull market. Okay, so you can see if we retrace past 100%, that would, be a reversal in the market. So I classify these retracement levels into two groups, shallow and steep. The shallow retracement levels would be 23.6 and 38.2. The steeper levels would be 61.8%, 78.6%, and 88.6%. And 50% is not a Fibonacci retracement level, but it is the halfway point, right? It bifurcates the entire impulsive movement that you're tracking in two. And then it's just the complete opposite if you're tracking a bear market wave. Okay, so here are some guidelines. Sharp corrections, so going back to the patterns that I've been covering here, so specifically zigzags and double zigzags, tend to retrace between 61.8% and 88.6%. So that's really cool in and of itself, because now we have an expectation based on the type of pattern we're tracking, which we know, there's just a quick callback to my class on zigzags. A zigzag is a 5-3-5 pattern, which means wave A is made up of 5 waves, wave B is made up of 3 waves, and wave C will be made up of 5 waves. So if I can count 5 waves for wave A, then I'm most likely dealing with a zigzag, right? And if I'm dealing with a zigzag, then I can expect a sharp Fibonacci retracement percentage of 50% or greater. So we can see here, we have a 5-wave impulsive decline in the Canadian dollar Japanese yen currency pair. And then we get a 3-wave ABC zigzag corrective rally, which retraces 78.6%. Now, we always want to be combining Fibonacci relationships, all right, with other forms of technical analysis. So look at what we have here, a prior swing point. Swing points will always work as potential turning areas on a price chart. So we see that here the wave 2 extreme worked really well at containing the entire corrective advance. And you can see the impulsive decline that followed. Here in the dollar CAD currency pair, we're tracking an unfolding impulse higher, and we can see that wave 4 here took the shape of a flat. Flats are sideways price corrections, and you can see here that this flat found support at the 38.2% Fibonacci level. We have one more zigzag here, right? This one's in the Dow Jones Transportation Average Index, all right? This is just to show you that this doesn't have to be applied on currencies. You can apply this to any market. Here again, we have a zigzag, retrace 61.8% of the prior impulsive wave. And again, prices stopped. I mean, I know they exceeded the wave 4 extreme, but within, I'd say, reasonably, they didn't go too far past the wave 4 extreme, and prices actually ended up closing on a daily basis below the wave 4 extreme. So in conclusion, Fibonacci retracement levels offer extremely high probability turning points. We can narrow down which retracement levels offer the highest chance of working as support or resistance based on where we are within the larger Elliott wave cycle. And then finally, we can further narrow down the type of retracement level we expect the market to reach based on the type of corrective pattern the market is tracing out. So remember, our sharp versus sideways patterns. As always, I hope this video is helpful to you and helps you advance your own trading, teaches you something new, or at least introduces you to something interesting that you hadn't considered before. So I look forward to hearing your feedback as always. Look forward to continuing the conversation. For now, that's it from me. See you guys later.